In Signal Episode 8, we explored the importance of portfolio rebalancing and brought it alive through the story of Sanjay, Vijay and Ajay, three friends who took different investment paths and ended with different outcomes. Today, in Signal Episode 9, we'll build on that foundation. We'll cover market highlights for the week ending 26 September 2025, an important mutual fund update, then dive into strategy, story and quote of the week, and finally wrapping up with key takeaways for your investment journey. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. Sensex closed at 80,426 points, down by about 2,200 points from last week's close. Nifty ended at 24,654 points, slipping nearly 673 points from last week's close. Selling was broad-based this week. IT, pharma, large caps were all under pressure, while PSU banks and selected mid-caps showed some resilience. Foreign investors turned net sellers because global cues remained weak. Domestic institutional investors offered some support but couldn't fully offset the outflows. The rupee ended near 88.09 per US dollar, holding steady despite equity weakness supported by softer dollar cues. On the bright side, HSBC upgraded its outlook on Indian equities to overweight and expects the Sensex to potentially reach 94,000 points by the end of 2026. What do you think? Will HSBC be right in their forecast? And why? Do let me know in the comments. So overall, a weak week for equities, but steady domestic flows and long-term optimism continues to underscore India's growth story. In mutual fund space, one key news this week was that unclaimed money has shot up nearly by 20% for financial year 24-25. According to SEBI, over 3,400 crore of dividends and redemptions are lying unclaimed. And what does this mean? And why should you care? It means that thousands of investors are not claiming their rightful payouts, dividends, redemptions, or maturity proceeds. Money that should be working for them is simply sitting idle with fund houses. And here is the call out. This could even be your money. You may have changed addresses, overlooked a payout, or a family member might have missed it. Either way, it's worth checking. And if you're watching this video, share this information with as many people so that they can claim their unclaimed money and put it back to work. This week, market showed us both sides of the coin. Jitters from sudden surprises and optimism about India's long-term growth story. And that's exactly where balanced advantage funds shine. They cushion the downside when volatility hits, but don't leave you behind when markets recover. These funds, also known as dynamic asset allocation funds, automatically shift between equity and debt. When markets are overheated, they cut equity and move towards debt. And when markets are attractive, they raise equity and capture growth. Think of these funds as your portfolio's automatic gear system, adjusting smoothly without you stressing over every market turn. And considering the value these funds bring, SEBI in 2017 officially introduced Balanced Advantage Fund or Dynamic Asset Allocation Fund as a separate designated category. Prior to that, funds like ICICI Prudential Dynamic Fund, which was launched in 2003, acted as a precursor. Later in 2018, ICICI Prudential Dynamic Fund got merged into ICICI Prudential Multi-Asset Fund. But its performance history provides us useful evidence. For example, in major stress years like 2008 global financial crisis, ICICI Prudential Dynamic Fund was down by minus 25% compared to minus 40% in equity funds. In 2013, during taper tantrum, ICICI Prudential Dynamic Fund was up by about 5% while equities slipped to minus 3%. In 2020, during COVID crash, ICICI Prudential Dynamic Plan was now ICICI Prudential Multi-Asset Fund fell by -8%, while equities fell by -23%. Across these major crisis events, dynamic asset allocation cushioned the volatility and in some instances also stayed positive. And here is an important thing to note. Not all balanced advantage fund follow the same model. Some use valuation-based model like price to earning or price to book. Some use volatility-based models like adjusting equity depending on market risk levels. And some use momentum or sentiment-driven models. The outcome ultimately depends upon model chosen, discipline applied, and fund manager's execution strategy. And here is where a SEBI registered investment advisor can add real value. They not only help you decide which would be the right model to adapt in your portfolio, but also help you choose what percentage of your portfolio should be allocated to balanced advantage fund or a dynamic asset allocation strategy, depending upon your age, stage, and goals. For story of the week, let's meet Meera and Ramesh. Both started investing in mutual funds few months prior to COVID crash. When markets declined sharply in March 2020, Ramesh panicked. He stopped his SIP, sold a part of his portfolio, and stayed out of the market until things were calmer. Meera, on the other hand, stayed the course. She trusted the process, continued her SIPs, and did not let fear take over. By late 2021, the story flipped. The market recovered to new highs. Meera's portfolio had bounced back stronger because she kept buying at lower prices. Ramesh eventually reinvested but missed most of the sharp recovery, leaving him behind despite starting around the same time. This story shows us how emotions can cost investors dearly. Most investors don't struggle because of market itself. They struggle because they react at wrong time. And yes, it's easy to say today because this event is behind us. But in my experience, it's during these major events when investors lose their temperament, exactly the time when they need it the most. And here is where a SEBI registered investment advisor can contribute. An experienced investment advisor can provide the data, the logic, the statistic, the rationale, the reassurance, the discipline, the perspective, the reminders, and most importantly, the clarity that is required for you to stay invested in fearful times. Because the history shows us that as long as we live, breathe, and consume basic goods and services, markets will bounce back simply because markets are nothing but a collective value of goods and services that we consume. As Peter Lynch once said, far more money has been lost by investors trying to anticipate corrections than has been lost in the corrections themselves. And that's the essence of today's discussion. Often investors lose more money by trying to time the market than simply enduring the correction. So, what's the lesson here? You don't win by outsmarting corrections, but you win by staying disciplined and consistent. Balanced advantage funds help solve that problem. Instead of you second guessing, they adjust automatically by reducing equity when markets are overheated and raising equity when they turn attractive. And with the right allocation guided by a SEBI registered investment advisor, they ensure that this strategy fits your personal goals, life stage, and portfolio needs. We are building a strong community of bona fide, benevolent, and brilliant long-term investors. If you're one of them, why not like and subscribe us and tell us in comments what's that one investment habit that you're working on this year.